On week 7 of Power Hour. We have one more to go after this one. So today we have Philip with us, and he is going to talk to us about making smart money moves. So have all your questions ready. And Phil, over to you.
Over to me. Hi, morning, everybody. It's a pleasure to be here at your Power Hour.
Yeah, so thanks so much, Phil, for coming. Fill the gap. Welcome, everybody. I know this is the most requested episode, so we're all excited to be here because we all want to understand how to make more money, right? All right. So, Phil, first question, we're going to jump right into it, is what is smart money moves?
Okay, so, and I would start by telling the audience to look to the person at your left and then right and just say, I make smart money moves. All right? So, and I'll tell you why I did that. Well, a little bit of icebreaker, but the reality is sometimes you may not feel as comfortable where you are on your journey with money, and that is a normal feeling, for most people. But the thing about that is there are things that you can do. And I think people are consistently, a lot of times, what you do is you either wait till you get the increase in salary or just hope that it's going to work out. So I'm saying that it's not going to work out. What's really important is your financial education. So I'll just give you some stats. They're real stats, right? It says that 1 in 3, so you don't need to look left and right, but 1 in 3 people, this says Standard and Poor's did globally. In the Caribbean as well, 1 in 3 people is financially literate, right? And that's nothing to be embarrassed about, but what that means is that 2 out of 3 people, they don't have the ability to make smart moves with their money. The byproduct of that is that 1 out of 3 people may have far more credit card debt than money saved for emergency. 2 out of 5 people will reach retirement and have no retirement savings. And the people who actually do have retirement savings may be using those retirement savings to take care of an emergency. Sounds like a dismal story, but those are the hard facts. Those are stats from the United States. And I will venture to say, I'm not saying that we are better off, but an advanced nation that has so much more tools available for people to help them advance in their personal finance journey, I would say, let's just say it's the same for us, right? 1 in 3. So making smart money moves is really understanding how money works. So when you earn money, how exactly does money work? And how can you get it working for you? And for that to happen, it's really about making the right decisions. Simple terms, what are the things you're doing with a credit card? Do you really understand how a credit card works? Are you using it to your benefit? If you go to a loan officer, what are the questions you need to ask them? If you're taking out a mortgage, a car loan, how long the loan should be? So those are the types of questions that you should be thinking about when, because debt is part of your finance journey as well, right? So making smart money moves, let me sum that up. I know it's long-winded. It is the first thing, 5 pillars. Budgeting for your life, not for anybody else. Budgeting for your life, right? Saving with a purpose. So one of the first things that you should be saving for is an emergency fund. Setting smart financial goals, and setting a goal, there's a way to do that in terms of really putting your goals down on paper because they mean something to you, especially the big ones. The 4th thing will be managing your debt wisely, and the 5th is investing to create wealth. And those are the 5 pillars of PTG. So that, if you have the ability to do that and you can, that means that you are well on your way to making smart money moves.
I'm going to ask a question I think you must get regularly. Phil, I make a modest salary. I barely make my bills. How could I invest to become wealthy?
Okay. And I think, so generally, that may be the thought. I will put out saving and investing because maybe I'm waiting for this raise or I'm waiting for this bonus. I'll give you an example. A man of modest means, or a human being, a man or woman with modest means, you are making the right decisions on a consistent basis. you may have someone that's earning 10 times more than you, and you can position yourself to be far better off than them. Why? Because you never know. If you see someone driving a particular car, living somewhere, you have no idea what their debt profile is. You have no idea that they are living paycheck to paycheck. They may or they may not. So what you need to be concerned about is your financial situation. And there are different, I don't want to, because the easy answer to that would be yes, you should invest in the stock market, and you should invest in mutual funds, and you should have the right type of insurance. But the difficult thing with finance is not really understanding what is the best investment and how the stock market works, because that's what people think of as a lot of myth, a lot of mystery. The difficult thing with personal finance is having the ability or that discipline to consistently work with what you have. And somebody might say, well, boy, $100 is nothing in this day and age. That's not true. I'll give you an example. Someone who has $1 million mortgage, the rate is 5 or 6%. The monthly payment is $5,000 to $6,000. Whatever you do on a weekly basis, let's say you could save $100. So you save somewhere around $500 for the month. At the end of the year, that adds up to an extra mortgage payment. If you do that, if you take that extra payment, meaning you have 13 payments as opposed to 12 payments, you make that payment. I'll tell you what happens on a 30-year mortgage. You shave 5 years off of the mortgage. You save $200,000 in interest. And I know this because it's a user amortization schedule. It's the same tool that the bank uses. And so $100 may seem like a little bit to you today. What you have to think about is what the present value of that $100, what does it mean for my future goal? What does it mean for my goal down the road? Somebody may have 1,000, and that's okay. Somebody might blow 1,000. If you have $100 to save every week, it may mean, and this is a personal decision, it may mean making adjustments. You might like to eat certain things, hang certain places, do certain things. I like to do it too, so that's what I'm saying. This is a touchy subject. I stay very clear of telling people what they should and shouldn't do with their personal finance in terms of things that you like. But what I will encourage you to do is the little that you have, once you are focused on the goals that you have down the road, it is going to add up. So people of modest means can save to invest and create wealth, not just for themselves, but the peace of mind, possibly leaving wealth or something behind for someone. Those things are comforting as well. So don't try to shift your mind. Don't think about, yes, $100 is nothing. I could buy a round of drinks, or I could blow that in whatever. I could go on. Doesn't matter, because I'll probably wait until I get whatever increase, or it just doesn't matter. Shift your thinking towards, listen, actually every penny matters. Every penny matters. Every opportunity that you get to contribute, which is monthly, contribute to your financial goals, it is an opportunity. And if you waste the opportunity, you have one less opportunity. So you can count the number of salaries that you have. You can count the number of bonuses that you're going to get. If you waste it, right, which can happen, you deserve nice things when you get a bonus. You do deserve to probably treat yourself, but you also do deserve to give yourself, or not rob or steal or cheat your future self. That's a big reward as well. So every little bit, every drop is going to count, and I'm telling you that you can. There are investment products in Trinidad and Tobago that will give you access to the stock market with as little as $100. There is a brokerage firm, I should say, so without naming any names, and everything I'm telling you today, you can fact check it. There is a brokerage firm that will give you access. I know they allowed people access to the stock market recently with as little as $100. And it doesn't mean that you don't have the big money to invest in the stock market today, but the fact that you have a brokerage account to invest on the stock market, or you have $100 to invest in a mutual fund that's going to give you access to instruments that generate income and dividends. Don't look at your $100 lightly. You should never do that.
So the first smart money move really is the pillar of that is personal finance.
The first, yes, and the pillar is budgeting for your life. That is the beginning of creating your money master plan, because that's where it starts. That's how you know if you have surplus. That's if you have money to invest. That's how you know exactly how you are positioned. And the budget really should not really, the budget should never be in your head. Budget either should be on a piece of paper, an Excel spreadsheet, or today it's easy. There are apps on your phone. So there's an app called Expense Tracker. You go to the grocery, whatever you spend, you eat out, you pay a bill, it's right on your phone, so you can check, you can check yourself so you know what you're spending. And it's so sophisticated now, so it's easy now to keep track of your finances. That is the first space, because that's the only space for you to know exactly where you are. Because you'd be surprised, because you thinking, well, I spend 20 here and I spend 40, but it's going to add up at the end of the month. You'll be surprised. It's like, okay, I didn't know I spent all of this money. So it's the first pillar is budgeting for your life. That's the blueprint for you to know exactly you telling your money where to go, at least where because you may not have the discipline in the beginning. I know budgeting sounds daunting, but it's not, right? It's really setting up yourself so that you know exactly where your money is going. So if it's not going in the right place, you can redirect it.
I think it's a powerful example you use, that if you could create $100 in savings a week, that you could shave 5 years off your mortgage. I know the parameters are $1 million mortgage.
$1 million 30-year mortgage, yeah.
But
at the
five,
end of the year.
that's moving from 30 to 25
Yes,
years just by extracting $100 a week.
And saving almost $200,000 in interest, yeah.
You also used, in the example, you threw around some terms like present value. You want to explain present value and compounding?
Yeah, and that's just a fancy term. When I say the present value, so the present value of your $100 today means that, if you put it to something, it's going to earn interest, it's going to possibly earn dividends, it's going to be worth more. But you're not exactly certain what that's going to be, but it should be worth more. So just the present value, thinking of, so what you see in your hand today, what you have in your wallet, what you see in your bank account, the present value of that is far more than you might believe it to be. There's a technical term for all it, but we're not technical today, right? But for you and your personal finances, your $100 today, or whatever it is, $1,000, is worth a lot more to you than you think. And compounding interest, or it's really earning interest on interest. So that money, the present, so now you have $100, next year it's $110. The year after that, if it's the same interest rate, you're earning interest on top of interest. So that's the beauty of compounding, because now your money is growing for you and it's working for you. And that, once you do that consistently, that is how you start to accumulate wealth. And that's how you start to position yourself to have adequate savings for an emergency, adequate savings to do the things you need to do, at least to ensure that you feel comfortable and you could sleep peacefully at night.
So they say compounding is the eighth wonder of the world, right?
That's what they say, yes.
Yeah. I want to hone in into another smart money move, which you refer to would be debt.
Mm-hmm.
How do you use debt to create wealth? That's
right.
The one question. And the second question would be, how do you use debt smartly then, in terms of making sure that what is good debt versus bad debt?
Yeah, good question. So good debt versus bad debt. If you're taking a loan to buy a house, I would say that's good debt. Once it's a house that you can afford, right, and it's not in an area, you're not hanging your hat too high, you're working towards. So any debt that is working towards an asset, you're taking out debt to finance your education. If that's what you have to do, that's an investment in yourself. You're taking out debt for your child's education, that's an investment, right? The other thing is really now managing that debt. So sometimes, yes, you mightn't have $1 million saved, or let's say whatever education costs. What you want to do when you're taking out debt also is just to have a decent amount in terms of what the down payment would be, because that's, you have less principal to pay back. If you can't, that's fine, because there are ways to accelerate payments and reduce the principal amount while you're paying down debt. So I should have said before that extra payment should go towards the principal, and not the monthly payment. It has to go towards the principal, and you have to specify that with the bank. So good debt is for something that is going to benefit you in the future. Good debt, bad debt is not taking out a loan for Christmas or Carnival or to go for a trip. you know, because now typically what can happen is you might take a credit card and go to have a fun time, and the danger in that is you're really spending money that you don't have versus saying, well, okay, maybe I save up for a year and I go on the trip next year. Taking out debt or using a credit card, it's the most expensive type of debt that you would not imagine. It is anywhere between 25 to 30%. That's right. It is the most expensive type of debt. It's unsecured. You feel very powerful when it's in your pocket, and you have a sense of gratification when you swipe and do whatever you need to do. I get it. The backdrop to that is, let's say you have a credit card and you max it out. The limit is $10,000, and you're making the minimum payment. Minimum payment may be 3%, so anywhere between $200 and $300 every month. You will be in debt for more than 10 years, paying on that $10,000. You will pay almost 3 times the $10,000 in interest on interest. So the same way compounding works with investing, compounding when you don't pay down the debt and reduce the payments as quickly as possible, that is what happens. So typically, how I would use a credit card or advise anybody to use a credit card is make sure you have the money to pay it back. So I would use a credit card to buy groceries. I'd use a credit card to pay for a trip, but I have the money saved or whatever, plan for it. I have the money there, and I use the card and I get some benefit, whether it's points at the grocery, points to get miles, points to, that's how so you have to think about that, because what you're not seeing is how much debt you're incurring. You're really putting yourself in a situation, well, you're binding yourself, basically. So the difference between good and bad debt is debt going towards something that is going to produce or benefit something in the long run. It's going to benefit you, not something that is fleeting. And I know I didn't answer your question, Kavi, in terms of in debt like investing. So a lot of times people ask, well, Philip, should I take out a loan to invest in stocks? And for a beginner, I do not advise that unless you have someone giving you expert or who is qualified to give you financial advice, somebody who's an expert, and they're telling you, okay, take out this, because what they're going to tell you is they're going to ask you, all right, what is the interest on this loan? Possibly anywhere between 9 and 11%. So it's not 20-some%, but that too is an unsecured loan. So you're taking a loan to invest in stocks. The loan you're paying is, let's say it's 11%. You are basically hoping that your return on an annual basis either hopefully gets to 11% or passes 11%. So I would say the same money that you were going to pay down on the loan every month, then just invest consistently every month. And I understand the psyche. It's like, well, maybe I should take out this big amount, and if it doubles or if I think that's where the curiosity comes in, taking out. But I would not advise a beginner investor or someone, if you're really not sure who this person is that's advising you, to take out a debt to invest. Invest monthly, invest consistently, invest whenever you get a bonus, invest, whenever you have the chance to. That's when you do it. So I wouldn't advise anybody to take out a loan to invest.
Yeah, that's pretty risky. You need to know what you're doing if you're doing that, right?
Yeah.
I like the definition of good debt. Very, very simple. Something that benefits you in the future. Mm-hmm. I want to throw a name out here, Robert Kiyosaki. Mm-hmm. Gold standard book, Rich Dad, Poor Dad. I'm sure everybody knows what that book is. So he defines an asset very different to how the accounting version of an asset is defined, right? So the accountants will say asset is what you own, and he would define it as simply what puts money in your pocket.
Yes.
So you said just now, taking out debt for a house or a mortgage is good debt, right? Because I guess it benefits you in the future. At some point in time when you pay it off, you're going to own it. Robert says he's not so sure about that because it takes money out of your pocket because you have to pay the bank mortgage. And I know that could be a divisive opinion. Some people will agree with him. Some people will agree with the traditional view. What is your take on that?
Yeah, so my view, very good question. My view on that is, and I have a tremendous amount of respect for Robert Kiyosaki. So I read the book, I got introduced to it and those methods while I was at university. But you have to, again, remember when you're on your money journey, you have to apply rules and a scenario that's applicable to you. Robert Kiyosaki is a billionaire, right? And he has a lot of debt in his real estate, and this is what I would say. If you are taking out a mortgage to get a house, because I see the conversation of rent versus owning. My opinion, my personal opinion, so it doesn't have to be, this is how I feel. If I have a mortgage and I got a house that I am happy in, and this house now I can pass on to someone who I love and care about, a child, someone who I'm responsible for, that gives me peace of mind. The money that I pay via a mortgage on a monthly basis, or the money that I pay to maintain the house, because yes, you have monthly expenses, you have to pay the light bills, whatever, utilities. Once it's affordable, once I'm not buying a house in an area or trying to hang my hat too high somewhere where I cannot afford to live, I'm fine. If you're trying to get a house in an area or live somewhere where at this time you cannot afford to live, that's a problem. So owning a house is not a bad thing. Taking a mortgage is not bad debt. And I'll give you a personal example. Again, this is my story. When I started working, right, and I was very young, my salary was not what I thought it should be, right? Everybody was like, and even now I might think my salary is not right. But I said, when I started to figure out some things, I said, listen, this is what I'm going to do. I bought this truck. And I bought the truck in 2007. And I got it from this financial institution. The monthly payment was $3,800. So I paid off for the truck in 5 years. But typically what people would do, let me just get a brand new truck after 5 years. That's the sexy thing to do. It's the exciting thing to do. I said, boy, well, what if this money, this $3,800 that I'm putting towards this truck, what if I just start saving it towards a house, saving it towards something, because I paid off and not get a new car, right? And I saved for a very long time. I consistently saved that amount of money. And if I got a raise, I would. And that's how I was able to get a home. And I'm just to get a home or renovate a property by making sacrifices. So I accumulated a sizable amount, not the entire thing. So I did have to take a loan, but it was no mortgage. So I took a personal loan to just finish off. And one of my colleagues, who is a friend, said, well, Phil, basically said, but you will ship it. You will ship it. I'm telling you this. It says, you will ship it. You take all that money. You could have taken a loan. You take all that money to go and get, it was like they just didn't see what they were not seeing is the decisions that I made for my life. I lived a very simple life on my terms, right? And I have friends who have fancy cars and they live in fancy areas and they do fancy things, and I might hang with them from time to time, and there's nothing wrong with that, right? I know I like to drink beers. I don't like champagne. I know I like to hang in this particular establishment. I don't need to go there. I know these are the things. I bought a truck. I like the beach. I play football. So these are things were exciting. So I didn't feel bogged down. So again, this is a personal decision. But that's how I was able to get my home. I said, I told you, it's 2007. I still have the truck. We're in 2025. And people would laugh at me or say, well, you're cheap. You're boring. You are, a girl might not want to date me because I buy a truck. I have a truck. That's real. Possible. So when somebody tells you something, if get a second opinion from someone, a professional, what your goals are, down the road, this is what you're working towards, and this is the decision that I'm going to make, so I'm going to take this money to do this. And there are people out there who can help you. And so to the point of somebody saying, well, buying a house is stupid or taking a mortgage is stupid, I think that they are not honest with that entire conversation. And a lot of those people who put that out into social media, they own houses. Many. Right? But it's sensational. It's for the masses. You are doing something stupid by getting a house that you can pass on to your child. That does not compute to me. Right? So if you're getting a house that, again, as I said, they can't afford, then, that's a problem. But no, and again, I just say with the utmost respect, I have a lot of respect for for a lot of things that Robert Kiyosaki. That's the one thing that where I say that's a personal thing. That's personal.
Yeah, no, I was listening to a song by Robert Kiyosaki like 2 or 3 days ago. It came up on the feed, and he was saying something about ETFs, 401k, Roth IRA. So a Roth IRA, just anybody in the audience, so the 401k would be our version to that would be like future cash, a pension fund.
Pension, yeah.
And he was saying that that's not a good move because that's taking money out of your pocket. And in my mind, I'm like, I cannot comprehend that. So I know it's out there and it's sensational. I want to ask one more question, and then I want to turn it over to the audience because I know we're going to have a lot of varying questions here that we could ask Phil. So I think the last money move that you were talking about was investing. Let's say I have $500 a month, between $500 to $1,000 a month to invest. The investing world could be daunting, it could be complex. We have gold, we have cryptocurrency, we have ETFs, we have mutual funds, we have regular savings, we have the local stock exchange, the foreign, you name it, right? What to do with my $500 a month?
All right. So I'm going to answer that. So you have the $500, right? The first thing I will say to you have the $500. The first place before you start investing, be sure that you could invest this $500. Be absolutely certain. Meaning, you have money set aside for an emergency. You don't have credit card debt. If you have credit card debt, pay off the debt. If you don't have an emergency fund, make sure you save up at least 4 to 6 months. It's not going to happen overnight, but make sure you have money set aside. So you have the $500. So you determine, okay, you're financially, you're good. You can be investing. Then what type of investor are you? So you should do a risk tolerance test. It's just really just answering questions about yourself, and you're going to get a score. And you will know exactly what your risk tolerance is. So they ask you a series of questions. Once you get the risk tolerance done, then I should be positioned here, I should be positioned there, meaning somewhere in the spectrum of moderate or conservative, moderate, and aggressive, or somewhere in between. Depending on your age, if you're ultra conservative, meaning if I invest $1 and tomorrow I see it's 99 cents and I'm not going to sleep well, then you need to think about if the stock market is for you. But you also need to think about the risk in being ultra conservative. There's risk. There's a lot of risk in not taking risk. There's a risk in taking the wrong type of risk, but there's a lot of risk in not taking risk. And the risk is you are cheating or robbing yourself from what achieving, giving yourself the best shot of what those future goals that you're trying to get. $500, you can invest in a mutual fund. A mutual fund, think of a mutual fund as a basket of assets, stocks, bonds, or one or the other. And you have a professional money manager or management team that manages it for you. You pay a fee for them managing it. And there are different types of mutual funds. So there are about well over 60 in mutual funds in registered mutual funds in Trinidad and Tobago, with different, some of them heavily skewed towards stocks, some of them are blend between stocks and bonds, and some of them ultra conservative with just like money market instruments. Let me just see if I could simplify that, but probably you'll get an opportunity to ask me those questions. Well, what is a stock? What is a bond? What's a money market instrument? A stock represents ownership in a company. If I buy Massy stock, I have a part ownership. If I have a brokerage account and I bought Massy stock, I am a part owner of Massy. And you have the opportunity to generate passive income. That's a stock. It represents part ownership. There are 2 ways a company can raise capital. A bond, which is a fancy way for a loan, which is a gigantic loan, or I'm going to give up some ownership to investors and share some of the profits with them. So you invest in either or. So there are mutual funds that invest only in stocks. on the local stock market or international stock market, or then there's some that invest in stocks and bonds, like a balanced mutual fund. A bond is, again, a gigantic loan with specific terms and conditions. So it's different than a stock. Because if a company doesn't make profits one year, investors probably not going to get a share. There's no profits to share. So you're not guaranteed to make profits. The difference with a bond is their terms and conditions. Is a contractual agreement. So I know when interest is going to be paid. I know when the principal is going to be paid back. So the return on a bond or the earning potential is a lot less. But it provides stability. So an example of a bond would be the government of Trinidad and Tobago might raise a bond to build a road or to pay salaries. Or a financial institution might raise a bond to buy computers or buy another bank in another country or buy another brewery in another country. People raise bonds, corporates raise bonds, and governments raise bonds. These mutual funds have these assets pooled together. So they're different kinds, and depending on the types of assets in the mutual fund, which is specific for you to ask, because a lot of time we ask people, so some of you may have a mutual fund here, but I might ask you, well, what type of fund you have? You might say, well, I don't really know, I'm not sure, I don't know. What's in the fund? Well, I don't know. Here's the problem with that. Here's the problem. You don't know if you are consistently contributing to a short-term goal type fund or a long-term goal type fund. And you might be thinking you're contributing to a product that is long-term, but it's really short-term. You're getting somewhere between 1 to 2 and 3%. And then you're upset or angry at the end. It's like, but it's not earning anything for me. But the challenge is sometimes we may not ask questions. But when you meet a financial professional, their job is to explain everything you need to know. So you could never be a burden because you are basically purchasing a service from them. You could never be a burden. Any financial professional, you go to the loan officer, can I see the amortization schedule? You go to a CSR to open an account. What is inside of this account? Is it stocks? Is it bonds? Can you explain that to me? What type of earnings or what return should I expect? And those are the types of questions you want to ask. So a mutual fund is one. You can put the 500 into a mutual fund. Or you could say, you know what? I'm going to open a brokerage account. A brokerage account is just like a bank account, but you're going to put money in the account and you're going to tell the broker to buy shares. So it's not a savings account, it's an investment account. And there are 8 registered brokers in Trinidad and Tobago. Some of the financial institutions provide this service as well. So a brokerage account is very different than a bank account in terms of what is offered. But think of a brokerage account like going to say, all of the stuff that the KYC stuff you would need, 2 forms of ID and all of those things. You open a brokerage account and you have access to the stock market. So you can take the $500 and invest in Massy stock. But that's not investment advice. I'm giving you an example, right? I have to put that because I'm on record, right? But you have access to buy whatever stocks you want, right? What you need to know is you need to have access also to a professional, someone who has experience, who can guide you through this process. So the $500, you can put it into a mutual fund, a different type of mutual fund, one that is safe, one that is balanced, and one that's a bit more aggressive and has more risk and is long-term. Or you can be a little more aggressive and put it in the stock market, or you can do 50-50. You can have a mutual fund and you can have stocks. Because you say, you know what, I want the best of both worlds. I want to be a little bit aggressive here and consistently. But the most important thing is being consistent over. That's the best return that you're going to get, that you're going to give yourself. It is the best return, contributing to your goals consistently every month.
Great. All right, we're going to go straight to questions because I know they have a lot of questions that you all probably want to ask. So usual thing, we know we do this. Pull up your hand, our mic is going to come to you. We have one already from Brent in the first row here. All right, we have a lot. And Rihanna, you could just manage for us the online questions as well. So, yes.
Brent?
Hi, good morning. Thanks for being here.
Brent?
Yeah, Brent.
Yes. Yeah.
Now, there are going to be a lot of questions. I personally have a lot of questions. But I think one of my main ones is, what is your faith, do you have faith in our local stock exchange or local stock market? Now, there are few firms, Massy being one of them, that I'll raise a plug for. You have things like Republic Bank. You have one or two others that will pay dividends. But overall, generally, what is your take on the local stock market? Because we look at it over and over, and it's not looking great. For a while now, it hasn't been looking great. So, what's your take on that?
So good question. And I will lead off by saying, yes, I do have faith in our local stock market. And I say that because, so you mentioned some companies. So in my role, in my professional life, that's my job, to get under the hood of a company and look at it and see if it's a good company or a bad company. Is it a good investment or a bad investment? Overall, there are some very good companies on our local stock market. The issue with our local stock market right now is that, so this is how the stock market works. When there's more supply, when people want to sell stocks, it can drive down a price. But intuitively, there's no reason, without mentioning any company, because you seem to know, so you will know where I'm going, but this is for everybody. There's no reason for a company to be generating billions of dollars in profits, but the stock price is not reflecting that. The reason for that is now it's a structural issue. Structural meaning, okay, so our market is not as advanced as international markets. So you have times when these things can happen. So what you're saying is, I know the pain that you're feeling right now, but you're looking at the market over the last 3 years. But if you look at the market over a very long time, and you see that chart, the chart is like this. Generally, that's what happens with stock markets over the long term. So you're right, it's a fair question to ask. So yes, I do have faith in the stock market. But yes, I am concerned of what is happening right now, because the only thing I would say is because Trinidad is not, remember, so the market moves with cycles. So if things going good in Trinidad, meaning if people are spending more money, they're buying more drinks, they're taking more loans, they're doing whatever, those things go down to the bottom line. They have profits, more profits. So the stock market reflects what, or should reflect what's happening in an economy. Trinidad is in a space where it's not a dismal story, but it's not a great story economically. We are in an okay position. Things should get better in 2027. Don't quote me, I'm not the Minister of Finance, but based on what the independent parties are saying, those are not necessarily based on what in the same S&Ps and all these entities that rate countries, because of our energy situation, which should have a different outlook in 2027. If that happens, then hopefully we should see a better return and a better performance on the stock market. But then I'll argue with you and say, listen, if the stock market is down now and it's a good company, do you think this company is going to be around next 10 years? So why not invest in the company if it's at a low price, right? Because that's what you want to do. You want to invest low and catch the wave. But I'm also not saying that that's what you should always be doing in terms of waiting for the right time. So time in the market, meaning the length of time in the market, versus timing the market. Trying to time the market is two different things. Trying to time the market for whenever is the best time to get into the stock market could be very dangerous, because you might be missing out on returns because you think, well, it's not a good time. So very fair question, Brent, very fair. But yes, and if it is you do have concerns about the stock market, I understand. I am also a retail investor, and I feel the pain as well. But that is not going to stop me from investing in our local stock markets and taking the opportunities with some of the great companies that's available to invest in.
Great.
Me? Oh, hi. So we're speaking about saving for emergencies,
Yes.
about paying off your credit card debts, about investing. Where do credit unions fall into this?
So credit unions provide two things. So they provide investment or savings products. So it just depends on what kind of rate that you are going to earn. So you can invest in a credit union. That's also a good investment vehicle, depending on the type of credit union and the professionals that are making the investments, because their business is selling loans, right? Their business is selling loans. So what you want to do is assess a credit union that has good investment professionals, right? You want to, if they are making investments, meaning they're going to invest in bonds, they're going to invest in stocks, what portion of that money and who's really looking at that, that's one thing you want to check out. And the other thing, credit unions, rates are usually lower. So you might have more favorable terms with a credit, may have more favorable terms with a credit union in terms of getting financing. So they do play an integral part or a huge part in your financial journey. And there's nothing wrong with getting a loan from a credit union. And there's nothing wrong with, once you know the company and what type of, if it's an investment product, you just get behind what is happening, ask the right questions. So yes, if you're thinking about getting a loan from a credit union, you should go for it.
Thank you.
What about, just a follow-up from that question, what about saving in the credit union versus a bank?
So it's the same thing. Oh, well, saving with the credit union, you're probably going to get a higher rate than the bank. You're probably going to get a higher rate because it may be an account that they are investing in. But the easy way I would say to assess that is shop around, because a lot of times you might feel as though you are committed to this financial institution, and you have this relationship with this institution, and you don't want to shop around, find out who's giving what rates, and choose the rate that's best for you. So you can save in a credit union as well and get a decent return.
It's funny you mentioned you shop around, because I think financial institutions are like sticky institutions, meaning to say it's very difficult to move from bank to bank. If you have a mortgage with one bank and you want to move to another bank, it's very difficult. It's not a fluid situation. But I guess the fact is, if you go and you take the time to actually shop around, you could consistently bring down your interest rate. You could on debt, but you could also get better interest rates by shopping around and moving money around by looking around, right?
Correct. Kavi, if I came to you, if you were a loan officer, and we've been in this financial relationship for a lengthy time, and you know that I'm good, I pay my debts, I pay, you watching, and I tell you I'm going to take what's the rate you can give me? I say, is this the best rate that you can give me? Yes, Phil, it's the best rate. I said, really, is it the best rate? Okay, let me get back to you. I check another institution, and they say, well, I could give you 50 basis points less or 25 basis points less. And he said, really, you could do that? Yes, if you bring your loan with me, if you bring your loan and you move your salary and you have the same arrangement with me, of course I can do that for you, Philip. I come back to you and I say, listen, here's what such and such is prepared to do. This for me, the one out of two things is going to happen, because it's the truth. They're gonna say, because their business is selling loans, they have targets to make. So there is flex. Don't ever think that there isn't flex. I mean, flex to a point. So not everybody gets the same rate, and not everybody negotiates the same way, and not everybody's going to shop around and say, listen, I'm going to take my loan and I think I'm going to get this mortgage somewhere else. They're not going to do that, because it's going to impact their year-end targets. So it's quite possible you can find a scenario where you can negotiate with a loans officer to get a better rate. So you might even have to move, but just the thought of you moving is going to jolt them and say, listen, all right, let me go and talk to my boss. I mightn't be able to make this call, but let me go and talk to my boss and see how we could work things out here. Versus just saying, yeah, this is it, here you go.
Yeah, and I know we come into the question, Kadeen, but just like Phil, I want to make a disclaimer. This is not financial advice from me, but to the point about negotiating with your loans officer, one of the things I know banks tend to do, they tend to put clauses in your contract that could be penalties. So for instance, if you take a mortgage with them and you pay it off early, you're going to get a penalty. And it's up to you to read the terms of your contract and to negotiate that properly, because if you do negotiate that, you could save yourself the penalty in early payment, and it also allows you the flexibility to move from bank to bank if you are getting an interest rate, right?
Yeah, so usually correct, right? So, and usually with financial institutions, it will vary. It will vary in terms of what, the penalties are. But as a general rule, most of them, they will tell you have X amount that you could pay towards the principal for a year. So in this year, you might be able to make an extra mortgage payment, or 2 extra mortgage payments, or 3 extra whatever the amount is, right? A percentage of the loan. You can make X amount of percentage payment towards the principal per year. If you go beyond that, that's where, the penalty may exist. And it's very important, as again, they say it's important to just ask the loan officer too. If you don't want to, I will encourage you to read the document, but the reality is many people are not going to read, and that's fine. But ask very pointed questions like, what are the penalties if I make payments towards my principal? Because they'll say, oh, early payments, yeah, I can make, because if the payment is going just straight towards the payment, interest and principal, is not helping you. If the payment is going towards the principal, remember the bank is getting less money. They're getting less interest. That's where the penalty comes in. They have already present value these cash flows. They know what your loan you are worth to them down the road, which is fine, and that's okay because the banks provide a service. I'm not knocking the banks, right? And it's not the bank's responsibility to. This is reality. It's not the bank's responsibility to determine if you could really afford a loan based on the goals you have and everything going on. They will just watch to see, listen, this is your debt service ratio. Of course, you could afford the loan. So yes, we'll give you the loan. It's not their responsibility to think about all of the other moving parts, but it's your responsibility to ask all of the right questions to get the best for you.
I think it's important to remember too, so they run a business, but the fact is the banks try to sell us something.
Yeah.
And if they are trying to sell us something, that means we are in a position of power because we have the ability to buy or not buy.
Correct. So yes and no, because if you need a loan, you need a loan. You need a loan, you need a loan. So that's why I say the banks, I wouldn't knock the banks because they provide an invaluable, they provide a service, they provide capital for things to happen.
No, absolutely.
Yeah, so what I would say is, yes, you have power to negotiate, possibly go to another financial institution that's going to give you better terms. And the power you have as, yes, you're a consumer. I could choose to buy the loan from you, or I could choose to shop here, or I could choose to shop somewhere else. You know, that's really what it is. So yes, you're right. And from that aspect, yeah, you do have power. You do have the power. You have the choice to choose where am I going to take this loan?
And again, we're not knocking the banks. The banks serve a very critical role in the industry, but continue.
Yeah, they waiting a long time. I hope it's not a hard question.
No. So Phil, I think a big problem is a lot of us don't know how to begin having these conversations with our financial institutions, right? For example, paying towards your principal. I only found out that because my sister worked at a bank at the time. What courses or books would you recommend for us to become financially literate?
But I'm going to have to do it. No, that's not hard. I'm going to have to do it here. So this year I launched a personal finance and investment education course. It's online. It's a 5-part module course that starts with you really journaling where you want to go with your money sets, creating your money master plan, not in your mind, but writing it down. I share my money master plan. My personal money master plan is there to show you how to write your master plan. That's the first step. Then a risk tolerance questionnaire. Then it moves into finding out what type of investor you are. The third part is really what the financial landscape in Trinidad and Tobago, what is available, and how you should position. The fourth is looking to know if an investment is healthy or not, doing a health check on a company. And I go through all of the companies on our local stock market. Well, not all, but most of any different sectors. And then the fifth one, how to build your investment team, which is meaning you as the right individual, as in feeling comfortable in yourself, and having a good investment advisor and the right broker, building your investment team. So I will recommend the iInvest course for you if you want to tighten up and start your money journey in a way where you can be confident that you're making smart money moves. Then the iInvest. Outside of that, books that you can read, there's Robert Kiyosaki, right? This says The Rich Dad, Poor Dad, The Richest Man in Babylon, Think and Grow Rich. All of those books they're great books out there. Most of them, conceptually it's the same story or fundamentally the same principles, but there's a lot of stuff out there on YouTube, on Instagram, and you can follow Fill the Gap on Instagram. I post daily or every other day and I talk about the things that may seem very high up in the sky and you may not know how it impacts your wallet. And I break it down in simple, bite-sized information that's digestible so that you can see, well, okay, I need this maybe this information is useful to me, or, okay, I knew that already. So that's what I would recommend. But I do recommend that you don't, after today, don't think about winging. Never wing. You can't be winging your financial journey. So you have to see yourself as, so a business, when they make profits, they know what they're going to retain, what goes to retain earnings. These are the profits we have, what is going to go here, what we're going to spend, what we're going to do to, they have policies. You have to think about what's your policy at the end of the month, because your business is very serious business. Very, very serious business. So you never take it lightly, right? So once you start thinking about yourself and your dollars and your money like that, and a big part of that is your financial education, so that you're going to make the smart choices that you need to make, or you're going to have access to people or a team that will tell you, this is the decision that you should be making, or this is the right decision, or actually you might need to adjust. Hello, is that Chris? Hi, Chris.
So for many of us, when you talk about investment and stocks and bonds, it's far away from our daily lives, right? But we make day-to-day financial decisions every day. Do I buy a pie? Do I buy a burger? Do I buy doubles in the morning? And for a lot of us during the pandemic, we retain a lot more money than we did after the pandemic, because food places were closed, KFC was closed, Massy Stores was the only best chicken in town, them kind of things.
That's true.
How do I build my financial discipline on those day-to-day financial decisions, as opposed to this up in the sky thing that I'm not going to do on a regular basis?
I'm going to tell you how, Chris. And it's something I had to do. Now, if I say 2025 is coming up and I want to save more money, that's a great goal. The way you start dealing with the psyche of how you operate your money, the way you start, you have to write down your financial goals. And a financial goal could be anything. I want to save more money. But then you really have to define that. So it's not a SMART goal. SMART meaning it has to be specific, measurable, attainable, realistic, time-bound. Specific. So I want to save $1,000 every month. So by December 31st, 2025, I will have $1,200. That's specific. You would know if it's realistic, and I'll tell you why it's important to frame your financial goals like that. So that is what will stop you from making, or even if you make a decision that is misaligned, you're going to come right back. Because here's what's going to happen now. The next thing when you do that, when you write down that goal, right, the specific goal, you're going to write down, well, what are the benefits I get from this? What are the actual benefits? And you have to go beneath the surface. Well, no, yes, you're going to have more money. You'll have $1,200, but no, I will start to feel confident that I have the discipline. I would feel, that I am making better decisions. I might have money towards my emergency. All of the emotional aspect that goes towards making these decisions that we think is simple. So that's what I'm going to benefit. Well, what do I lose? Well, I lose all of that. What are the things that could stop me? You're writing all this down. Well, the things that could stop me is, if I don't have a conversation with my partner, if I don't have a conversation with my friends to say, listen, this month I might be doing a little bit less because, I can't make this trip, or I can't do this, or I can't because of, these are the things that, or what could stop you is not having a budget. What could stop you is all of the things that could stop you, right? Just think about it. Well, what could you do to prevent that from happening? Well, I'm going to go and download a expense tracker app. I'm going to start looking at videos on YouTube. I'm going to start doing certain things, that you're writing all of this down. What's the first action step? Okay, so the first action step is, well, I'm going to go online and find this, download this on my phone. I'm going to have this conversation with this person. I'm going to start, I'm going to try to talk to my loan officer. I'm going to try to whatever. So you're writing all of this down. The next thing is, who needs to know? Sometimes nobody needs to know, but sometimes the important people. The people, find somebody who cares about you, not somebody who's going to put you down. Somebody's going to check you at the end of the month. Say, hey, Chris, did you save that $100? Say, nah, boy. Yeah, boy, I did. Right? Those are the type of people who want to check you. And what you telling yourself? You tell yourself that you make smart money moves. I'm in charge of my financial destiny. It sounds funny, eh? It sounds weird. But the narrative that you create for yourself is as reality. If you want to make smart money moves or smart decisions, that's what you have to tell yourself. Don't tell yourself you're bad with money. I make smart money moves. I'm in charge of my financial journey. I have a money master plan. I am moving towards my goals. And have some kind of visual, whatever it is, on your phone. Stick up that goal that you write down on by your desk. I guarantee you, you will start achieving your financial goals. I'm not making that up. I'm telling you, I wish I knew that when I was 20, but this is something I started doing in my 30s. I write down everything. Do I hit every goal? But I write down this for all other goals too, other goals in your life, right? But for your financial goals, yes, that's how serious you have to be, because it's serious. But you're not, today you mightn't see it, you might just think it's going to happen. It's not. And if you want the planner, you want a sheet, I can email it to you. I can email it to you and you can have a look at it, and I can show you how that's done. Or you can enroll in the iInvest course, and the sheet is there as well. The sheet is there. You will see how I draft one of my personal financial goals, exactly how I told you there. And that's how you're not going to eat the pie. And that's how, because you remember, that's how you're not going to buy. You might say, okay, it's buy whatever, 10 or whatever, well, I buy 5. I don't know where it's buy by the bar. I don't know if it's go to the bar. I don't know. Whatever you're doing, I'm just saying, well, okay, maybe, I don't know if it's go to the bar every day or every other day or all those decisions, you would know. I'm just making, but I'm making light of the situation, but whatever it is, Chris, that is how you start not seeing that as a chore, but seeing that as something very beautiful and rewarding that you're doing for yourself. And it's not going to feel boring. You're going to actually feel very empowered. Eventually realize, okay, it's fine. I could tell my friends, it's fine. I'm going to skip this one. If your friend tells you strip it, well, yeah, I don't know. I ain't going to tell you it's not your friend, but you just, be comfortable where you are on your journey.
Phil, you said something there I think is exceptionally powerful. First, if I had to summarize the message is about discipline and it's a bit about consistency. But the word I used there was I have to be serious about it.
Mm-hmm.
And I like that, and I find it so powerful because, all of us here, we work so hard to get our money. 8 to 12 hours a day, whatever it is, Monday to Friday, some of us Monday to Sunday. You work so hard to get this money. You have to be serious about it, right? You can't.
Yeah, you can't. As I said, it's easy when you're in a situation. Bro, I've been there, when I now start to work. Listen, the things I'm telling you, I'll give you an example. I graduated, I got this job. I was in New York, working in a place where I thought I could never be. I was like, oh, how I end up on Wall Street? There's this TV thing. Right? Real story. I did an internship. When you finish the internship, they gave you a bonus to take the job because they didn't want you to go to another institution. I got this bonus and I was like, wait. I couldn't, I'm telling you, so I'm 23, 24, right? So they give me this bonus. I sent it, listen, I'm thinking, I told myself, I say, I'm going to live in New York and I would need this money when I retire. So I'm going to send it down to Trinidad. I opened a unit trust account. It's a true story. And I'm living in New York. I'm working at an institution. I send, the bonus was 15,000 US. I was flabbergasted. But guess what? Let me tell you. Very soon. So that's 2001. If you check back in history, there was a recession. I lost my job within about, let's say, 18 months. So now, you're bouncing around from friends. What you going to do? You're going to get, because I only have a year to get a job. What you going to do? You're going to marry somebody to get papers. What you going to do? You're going to bartend. You're going to valet park. What are you going to do, Philip? I have good friends. I was moving around, but I had to come back home. I didn't have a job. Guess what? The 15,000, that was my emergency fund. The emergency fund that I thought I was using for retirement. So that's the first, my dose of reality. They start to work, and even then when I started to work here and I got a job in Trinidad, of course, you're young. Of course, you want to do it. I spending money. I spend I wouldn't blow everything, but someone's, you kind of, but eventually once you realize you start to take your goals seriously, you have to change something because you are figuring out, well, where do you want to go? Something has to give. And I realized, well, I went to school, I have a degree in finance and a master's in finance, and there may be people who don't have a degree in finance will make far more smarter money moves than I would make. It's very possible. But personal finance is very, very different. But what I learned to do in school is build up the balance sheet of whatever company I'm going to work for, build up their profit and loss. But what about my balance sheet? What about my profit and loss? What about my money situation? What's my policy? What am I doing for me? The minute you realize that, you're going to start to move different. You're going to take it seriously. You will take it seriously because you will. I'm not again, I don't want, sometimes it could feel as though, well, boy, that's boring. It's not. You have to find that sweet spot for yourself. I'm not telling you don't go out. I'm not telling you don't go on the trip. I'm telling you that you need to just figure it out. You can't be winging it. You have to figure it out. And just take everything seriously. Have a great time. You need to have a good time. You work hard. You deserve to have a good time. But you also deserve to position yourself for longevity. It can't just be about today and now and here. And that's not taking it seriously. That's exciting for them in the moment, but there's a huge price to pay for that.
Hi, Phil.
Hi.
Hi, Aviel.
Hello. Hi, Aviel.
Diversifying investments. So someone starting off with limited capital, would you advise against it or for it?
Let me hear this again.
Diversifying investments.
Mm-hmm.
Someone with limited capital and want to now start investing. Would you advise them for it or against it?
Foreign or?
For it or against it.
Or for it.
Yes,
or
against
okay.
it.
Limited capital.
Yes.
Listen, if everything that I said checked out in terms of, so you don't have credit card debt, right? You have some emergency fund savings, limited. That's the amount that you can make. I always get that question, Phil, what's the best amount to start with? It sounds like that's what you're asking. Does it make sense to start with? You have to go for it. And the important thing is really determining what's your net worth today. And your net worth is nothing to be embarrassed about. So when you have your budget and you line up all your accounts, you have your retirement account, what you have in the bank, what you would know if you're in the plus or in the minus. But most people wouldn't do that. So you really build your own little personal balance sheet and income statement, right? You have that on a spreadsheet. So you'll know if you're in the minus, so you know if you're breaking even or if you're in the plus. Anything that you have surplus, after your budget, now you're budgeting for your life. So remember, you've already put aside the money to dine out, or put aside the money for the gym, or put aside the money for utilities. You've already put all those things aside for the life you want to live. Anything that you have that is surplus, you have to save it and invest it. You have to. Anything. So that could be $100. It could be $100,000. So of course, I would advise you, yes, you go for it. Start investing sooner rather than later. If you realize that your financial situation is not where you want to be, because okay, I need a little bit more money for emergency, I need, I have to pay down this debt, then no, you start, because you've seen it now. Versus spending the money, you would take more money, you would take more time to now put towards paying down the credit card earlier, or put towards saving for an emergency. So that's what I will advise you, yes, to go for it. Make sure everything checks out, and definitely start with what you have. So, and I'll tell you how important time is. I'll give you an example. Let's say you started investing $1,000 when you were 20 years old, right? Now, you should think about it, could be 100. It's the same principle that applies, right? You invest in 1,000, you started at 20. Versus the person that's starting at 30 years old. I know we have different ages in here, but just think about what I'm saying to you, time. The person who started investing at 30, in 20 years, right? So when they reach 50, they have, let's just say they're investing at a rate of 8% over time. You're not going to get 8% over here, but and the reason I use 8% with this simulation is because the stock market return is anywhere between 7 to 10%. So I go middle of the road, long-term return on the stock market. And you're investing $1,000 every month. The person that starts at 30 will have 600,000. Person that started at 20 will have 1.5 million. So that's very different in terms of the time and the amount that your ability to earn. So take the little bit that you have and stack it consistently. And eventually, Hopefully you get a raise. Hopefully you get a bonus. Hopefully things change. And as things start to change over time, the same habits that you're developing with this small amount, you're going to do it with a big amount. Because here's the problem too. Why I would tell you to start with a small amount. When you get the big money, or you get more money, you have the same habits. So now it's difficult to try to now get to say, well, okay, what am I going to do with this? I have money now. If you have the same habits, you wouldn't know how to save. You wouldn't know how to invest. You wouldn't have the discipline. You wouldn't have that mental muscle memory. So start today. Start today with what little you have. Once, as I said, all of the other things check out, and you're good to whatever surplus you have to sink it. Yes. So as a new investor, and diversify, there are two ways that you can. You can do it through a mutual fund, because remember there's a basket. So if one asset doesn't do as good, they have other assets that will pick up. So yes to diversification. Sorry I didn't answer your question directly. Yes, a resounding yes to diversification. And if you want to be a bit more aggressive and say, well, okay, if you were going with the stock market, you get professional advice from someone who knows about investing to tell you, well, okay, these are the stocks, or these are the investments you should be thinking about if you're thinking about this type of risk on the stock market. So you definitely want to diversify. Now, there are they're professional investors who, I know, they have the belief in this one company or two or three companies, and that is because they've done their homework, they've done the due diligence, they know exactly what's happening with this company, they know the numbers, they know what plans management have, they assess the company, and they're comfortable, and their risk profile and their financial situation can allow them to take that risk, right? So as a new investor, yes to diversification, and yes to just starting as quickly as possible.
Hello? Hi, Phil. Okay, so I have some questions
Hello.
coming in from online.
Hello,
What is
online.
the role of insurance in terms of building your savings?
Right. Good question. So in insurance, I'll tell you how I use insurance. Insurance for me, if you have people that you're responsible for, yes, you get term life insurance. If you, certainly for critical illness, because something may happen to you, and that could wipe out all your savings and investments. So you want to have insurance that takes care of critical, make sure that you know what kind of, you want to have that type of insurance. And I would say approach the insurance for pure investment vehicles. It is there for you, but just make sure that it meshes with your risk profile and the goals that you have. So you want to ask this insurance agent, what is driving the returns? What type of returns can I expect? And make sure that it lines up with the objectives, if it is for saving and investing. So I wouldn't tell you not to entertain an insurance product. I'll tell you need to have the right type of insurance, and all of your money should not go into an insurance. All of the money that you have set aside, all of it should not go into an insurance premium. You should have it split up. So you have to make sure that you have the right coverage. And a good insurance agent, remember they're selling. A good agent will be able to tell you, this is what is driving you. This is what the portfolio, because it's an investment portfolio. It's made up of stocks, it's made up of bonds, it's made up of money market instruments, it's made up of alternative investments, it's made up of this. And the returns will be this. So that's a good way to test an agent to know if they can't answer, it doesn't mean that it's not a good agent. It's an honest agent. They'd say, listen, you know what? I'm going to get back to I'm going to talk to the portfolio manager, and I'll get back to you. I'll revert to you to answer that question via email or whatever. I don't have the answer now, but they'll be honest with you.
All right, thank you. The next one is, so after you've paid all of your bills, how should you split the balance of your income to satisfy things like emergency fund, insurance, short-term and long-term savings?
Okay. Emergency fund. Let me hear that. Emergency fund.
Things like emergency fund, short-term savings, long-term savings, insurances.
Right. So I would class, if you don't have any money for emergency, that's the first thing you should start saving for. Because the thing that you think is never going to happen it will happen. And then you're probably going to have to ask your brother, your sister, your boyfriend, your girlfriend, your mommy, your daddy, I don't know who, somebody, a friend. You might have to ask for advance in a salary, so if it's depending on the type of an emergency. And an emergency, the typical emergencies were dental, car, emergency travel. So there are two types of people that might deal with that. There's the person that like block it out their mind, like this is never going to happen. And then there's the person that actually hoping it doesn't happen. And that the stress of that, it is So deal with the emergency first. And then, so outside of that now, an emergency is in a sense to its short-term savings. So it's money that you need to have accessible. So you want it in a money market account, like an income account, earning something decent, but you have ready access to it because it's an emergency. So this is a short-term type of account. Then the other short-term money that you have, that could be saving, you started saving at the beginning of the year to go on a trip in December, or you started saving at the beginning of the year because you wanted to do something special for Christmas. Then you could start dealing with that. And insurance, I would say, definitely get critical illness. You may not have anybody depending on you, but down the road you might have somebody, so get the premium probably when it's earlier, it's a lot cheaper than waiting until you get older. So that type of protection, yes. And if it's money that is you're going to put aside for investment or savings, just make sure that you answer the same questions that what is it earning, what are the prospects for, when I get this lump sum, what am I supposed to expect or what I'm looking for. But definitely first emergency, then your short-term savings. Also see if you could deal with the, as I said, illness that you want to deal with that. I know we do like to think about that, and I'm not an insurance agent, but I'm just telling you, I've seen it happen to people. I've seen it. I'm sure somebody in here has seen, people have unfortunate things happen, and then those things can wipe out everything. Or it's a burden for someone else.
All right, thank you. So,
Rihanna, just to drill into the question, because I think where that question was going was the balance of the funds. How would you split that up, like percentage-wise? It'd be like 30% emergency fund, 10% insurance, blah, blah, blah.
It would depend on, again, it depends on the financial situation, so it's difficult to say, but as a rule, there's the 50-30-20 rule, which is the 50%, you deal with all the non-negotiables, the 30% are the negotiable things. This is your salary. If you have $1, your salary is $1, 50%, you have to live, you have to pay utilities, you have to buy groceries, you have to do these things, 50%. 30%, you like to hang out, you want to do this, you want to do that. Those things that are negotiable, you have 30%. And then 20% saving and investing. Whatever the saving and investing vehicle is aligned to the goal that you have. And that's where you need to figure out. But certainly you have to have money set aside. You have to pay yourself first. So they call it the 50-30-20 rule. I like to flip it around and call it the 20-30-50 because the first person that you should pay, is yourself. And when I say paying yourself, it sounds weird. Paying yourself first means that you are making yourself a priority. It means that that's your business policy for yourself. I'm paying me before I pay the grocery. I'm paying me before I pay the utilities. I'm paying me before I pay the gym, before I pay anybody because one man's income is another man's earning. One person's income is somebody else. One person's spending, is someone else's income. So when you are basically paying somebody else before you pay yourself. If your business policy is that you pay yourself and you set aside 20%, then you're all right. You could deal with the other things after. So I would say that 20% of your salary, it depends on your situation. For sure, you need to have money for emergency. If you have credit card debt, you probably want to be using that to pay down debt because that is like an investment that you're making. Paying down your debt, credit card debt as quickly as possible is an investment because you're going to be spending a lot of money in interest. You will be saving money by paying it down quicker. And that's how I would say, pay yourself first. Try to make that your business policy. The money, how you split the money really depends on what you're working towards, what's your risk tolerance, And it doesn't necessarily have to be 20%. If you can't make 20%, then make sure you could save 5% of your salary. But make sure it could be 10%. And if you could save more than 20% after you do everything you need to do, when I say doing everything you need to do means living comfortable during the month. I'm not telling you to starve yourself. I'm not telling you to be unhappy. I'm not telling you to become a Scrooge and be cheap. But certainly be disciplined. And once you do all of those things and you have money, then don't just say, well, the rule is to put 20%. No, put 30 if you can. Put 35% if you can. Put however much you can. Because that's how you're going to get towards your goals a lot quicker.
But get serious about it, though.
Yes, Gabby. Yes.
Rihanna.
Okay, so Phil, the question basically is, so let's say they've taken all of your advice, they've paid their bills, and they've now have the balance of their salary, and they want to now start breaking it up into the different buckets. How does a regular person get more information on the different types of savings that are available to us here and the local entities that can be used for those specific purposes?
It's a very good question. So it might be very difficult to, the easy answer to that would be, you go to the institutions and you talk to a CSR, right? But that could be challenging. Time is tricky. You have to work. So outside of the self-help things that would be on the internet and on social media, that there's very, very good information. As I said, the program that I have breaks down all of the products that's available and how you should position yourself. What product is appropriate to you. The course also gives you access to me. You have access to someone, you have access to me who will answer questions and point you in the right direction. To tell you, you should be doing this, you should be doing that. This is a good fund for you. This is not a good fund for you, depending on the type of goals that you have. So it's really taking that ownership in your financial education. Really, that's what it is. And it could be start buying a book, going online, doing research, or just making a concerted effort to get the information. But don't try to do it on your own. And ensure that it's someone that knows what they're talking about. That's the best place to start when you have the money. Make sure you have very solid advice.
Okay, thank you. And the last question coming in, Phil, is how do you create generational wealth?
Yeah, so you know what, I guess a financial, what they would tell you, or what can be said, is the 3 ways to generate wealth is by, having a business, having your own business, real estate, so you have a property that generates rental income and passive income, investing in the stock market or investing in financial instruments that are aligned to stocks. Those are the 3 ways. How I will break down a stock is like passive. You may not have the time to run a business. You may not have that bandwidth. But certainly if you are investing in a business, then you're a part owner. And depending on how you accumulate wealth over time, now you are a significant owner and have a share in the profit. So a great tool to generate generational wealth is through the stock market. The stock market or products that are aligned to the stock market. And the reason for that is you're taking a long-term approach. So it's not short-term. Short-term, mainly when you're thinking about short-term, think about, as I said, the goals that are short-term, whether it is a trip, whatever it is, whatever you're working towards in a short space of time, that's fine. But anything that is 3 to 5 years and beyond, you want to put it in a financial instrument like stocks that will give you the benefit of that long-term growth. And the stock market, outside of owning your own business and getting into real estate, which are great things, but may not be easily accessible to someone today. You might be working towards it. Easy access to get a decent return and create wealth over time is via the stock market.
Just a show of hands, how many questions we still have? Just to plan out time. Andrew? Anybody else? One after? All right. Okay.
Hi, Phil.
Hey, Andrew.
Simple question, maybe a difficult answer. What are your thoughts on cryptocurrency?
Yeah. So I'm sure you've seen what's happening now, and there's a new president that is favorable to that crypto market. So cryptocurrency is a new asset class, and it's relatively new asset class versus the traditional asset classes that we know, which would be stocks and bonds. So how I would describe crypto is, so if let's say, for example, Massy, I can go download the financials, or anybody, and then I could do it, anybody here can do it, and you could see, well, this is what the profits have been like over time. This is how, this is the debt that they have. This is how the company's been run, and there's a way to assign a value to that type of asset. There's a way to assign a value to a bond. Crypto, because it's relatively new, you're not really kind of getting used to how do you value crypto. So it's not as easy to value it. I would say it's a risky asset class. So if you are not prepared for the volatile swings, so of course it's past 88,000 now. Everybody says it's going to go to 100,000 and it's going to go to $1 million. But I'm sure you saw when it went from 60 to 40 to 30 to it just started dropping and everybody was heartbroken. If you can't stomach that ride, then crypto is not for you. I would say you want to think of just like in investing. You want to, if I'm looking at the Trinidad and Tobago stock market, I want to know, well, what are the equivalents of a blue chip? What's a blue chip stock? What's one of the best or most solid companies? Or what are the best companies? That's what I want to go for. So I will tell you, you certainly, without naming any coins, you know the coins, right? You want to go to the coins that are not those coins that, because there are thousands of them, that just pop up and it's a game and that could be problematic. So you want to go for those kinds of coins. And the other way that you can access the crypto market is like the question earlier about diversification. There are crypto ETFs now. So even if one coin does bad, you have coins in there, but you want to get a good, you want to access the crypto market, you can go through an ETF as well, crypto ETF. True, but this is not on the local stock market. This is on the international stock market. There are ways to access crypto ETFs. So to answer your question, I can't sit here and tell you, boy, don't invest in crypto, and crypto is bad. Crypto is the future. Digital is the future. That's facts, right? They're going to have, I don't know what the central banks are going to do. I'm certain I know all central banks are actively doing research to develop a CBDC, which is a central bank digital coin. Everything is going digital. What happens in the future with the coins and who leads and what, I don't know. But certainly assess yourself and know what type of risk tolerance that you have. And if you have $1 to invest, don't put the whole dollar in crypto because you're trying to get astronomical returns. Put 5 cents. Right? You have $1 to invest, put 5 cents. You're feeling risky, you put 10 cents. But you want to have money set aside in other areas. You can't risk it all with an asset class like that. No, that is, I would say, relatively new, that you don't know what kind of swing it will take and when you would need the money. If you know it's long term and you're in it for then fine, go for it. Are you follow Fill the Gap? Yes. You follow Fill the Gap?
So I actually came across.
You're not going to answer me?
Pardon?
I said, do you follow Fill the Gap?
Yes, I do.
Okay,
so that's
you.
what I'm getting to.
Okay, thank you for
saw
following. No, I know you can see the video without following, but thanks for following.
Yeah, I do.
I appreciate that.
When I first saw the
you.
video, you spoke about the same brokerage account and opening one, and it really grabbed my interest. So when I saw, and I started following. So when I saw that you would be our speaker this week, I was like, I'll be in front row. Well, I'm literally not in front row. So I was quite intrigued. So listening to you today, I mean, it grabs my interest and right down my alley. But I have a few questions.
Sure.
I hope I'll be allowed to ask them.
Sure.
Not long. So one is, what are your thoughts on refinancing or borrowing a loan to clear off a loan? That's one. How do you go about opening a brokerage account? And three, what are your thoughts on unit trusts? Because
Okay.
I know you mentioned a couple of the accounts like
Sure.
mutual funds and stuff, and I know the
Sure.
unit trust has accounts like
Sure.
those. So if you can kindly advise or give your
Sure.
feedback on that.
No
So
problem.
just three questions.
No problem, no problem. So to the first one, refinancing, usually like if you have a lot of debt, I understand why some people may either refinance or think about consolidating. The thing with that is the only way that you're going to know if that's going to make sense for you is really in the numbers. You're going to have to get the amortization schedule, or you're going to have to ask them to show you. Or you're going to have to get someone who knows how to manipulate an amortization schedule to tell you, well, okay, it makes sense to refinance. And then what are you refinancing for, right? You don't have to answer that question. So it is no yes or no, and that's a tricky one. Consolidation of debt, you can sometimes find, or refinancing, you can find yourself in a worse situation. So doing something that you think, so remember somebody's selling you a loan, eh? So it may or may not be in your best interest. And the only way for you to know that is to get behind the actual numbers. What's the rate? What's the tenor? Well, the maturity, how long this loan is going to be for? How much interest are you going to pay if you refinance? And then exactly are you refinancing for, right? What exactly are you refinancing for? Is it something that is going to benefit you? So there's no yes or no to that. So the second one is how to open a brokerage account, right? So to open a brokerage account, there are 8 of them, right? The videos that you would have seen, you see me directing you to the TT, the Trinidad and Tobago Stock Exchange, that takes you to all of the list of brokers, and then you have their contact information, the emails and the numbers, and I'm telling you, I've done this test. You send an email to any one of them, they will respond to you within 24 hours. So you want to find out the information in terms of some of them. The starting point in terms of the minimum amount to open starts with like $2,500. As I said, I know recently one of them allowed people for a particular period to open a brokerage account with $100. I would say follow my video step by step, contact someone there, or you can message me and I can put you into contact with someone. So that's probably, you have different options. I can put you into contact with one of the brokers or a couple of them, for you to make but it's good for you also to do your own little background research to figure out what type of service, because they offer different products and some of them, they may have different charges, right? So it's not rocket science to open. The same way you're going to open a bank account, you have to have the same KYC, know your customer stuff. 2 forms of ID, proof of address, and right? So it's not difficult. I probably should have started off by saying that. Unit Trust is a great company, right? It's been around for decades. It's the largest mutual fund in Trinidad and Tobago. They have expert money managers there. And if you're thinking strength, safety, and stability, Unit Trust Corporation is a very solid company with competent professionals. I'm going to stick a pin right there. So this is where I have to tell you now, I am part of the investment team at the Unit Trust Corporation. And everything that I said to you before is true, right? We have some of the best professionals at the corporation. And what I would say is different. It's their range of investments that are aligned to a customer, that conservative, the same conservative, moderate, or moderate to aggressive. There are different types of funds there that would be or could be suitable for you. So you should check them out.
All right. So Phil, I just want to end off with some quick fire questions. ETF,
Right.
mutual fund, index fund?
Yeah.
Choose one.
ETF, mutual fund, index. All right, let me answer it. I mean, I don't want to, so let me break down what they are. So the ETF, so it's an exchange traded fund. So to the question about a mutual fund, you'll have to walk into the question about unit trust. You're going to have to come into unit trust or sign up online and you put money over the counter, you buy units. That's how you get a mutual fund or unit, any one of the mutual funds. And an exchange traded fund is traded on a, so think about a mutual fund, basket of securities or basket of stocks and bonds, traded on a stock exchange. So a good example of an index fund or ETF, but I would say an index fund, is the Calypso Macro Index Fund, which is a fund that's listed on our Trinidad and Tobago Stock Exchange. And it's a fund that is a blend between energy assets and local stocks on our stock market. So an index fund tracks a particular index. So it could be tracking local stocks in Trinidad and Tobago, it could track the energy sector, it could track financial sectors. There are different types of index and ETF funds. But it is passive. I would, the good way to describe it, it's beyond it just traded on the difference of it being traded on a stock exchange. It's passive management versus active management. So a mutual fund that has a money manager is actively managed, meaning you have someone looking at the market, looking at various economies, saying, okay, this is what is happening in this economy. I think this is the best country to put this dollar in that this person walked in and put into my hand. And you have a team of professionals, analysts, and portfolio managers that do that's active management. After I determined that this is the best country, well, okay, what's the best industry? Okay, so we're looking at this industry in this country, and then within this industry or industries, what are the best companies within the industry to really put this? So it's really drilling down. That's what you get with a mutual fund. With an index fund or ETF, it's passive management versus active management, which again is preference, is style. They're both good options. So I would say have a blended approach, right? You have a mutual, you could invest in some in mutual funds, some in an index fund or an ETF.
So you're not going to choose one?
Well, I mean, for you, this is a personal question for me. Yeah, just, and again, so the other thing too with an ETF is the fees are less. So when you're looking at a mutual fund, you have to assess the fees that they pay to money managers and just really determine it versus the fees of an ETF. But again, it's passive, so there's no money manager to pay, and see how the performance is. So really, me personally, I have both. Yeah. Right? I do. I have index funds and I have a mutual fund.
Forex is a big issue in Trinidad. We want to invest on the foreign stock exchange, but it's difficult.
Yeah.
So we capped by what we could access. How to navigate that, if any way at all?
Yeah, I mean that's a tricky one to navigate. I'll tell you why it's tricky, because Trinidad, and let me be very careful with this conversation, right? So we are TT rich and US cash poor. That's the reality. We have less US coming into Trinidad, and there are lots of TT dollars available to chase these US dollars. I'm just dealing with the facts, So it's very difficult to get US dollars. I don't think the banks want to punish anybody and just decide that they're going to just give US. There's a reason for that. There's less US available. I'm not going to talk about what the solution is for that, right? At least not here. But that's the reality. So it's difficult to get. So whoever your financial institution is, they have different, it just depends. So you may have a relationship with this financial institution versus that, and they may tell you can get X amount of US every week or X amount of US every month, and whatever US is available to you, that's how you're going to get it. Sometimes, I don't know, you may have, people do different things to get US. So again, I'm going to be careful with this conversation, but people do different things to access US. Once you're not doing anything illegal, then you want to accumulate US and open a US brokerage account, and they will give you access to ETFs, index funds, and all of these stocks that you could probably think about on the international market. And opening a brokerage account is very similar. An international brokerage account, sorry, is very similar to opening a brokerage account here. It's just a much more sophisticated process. You could do it on your phone. You could do it on your laptop. Once you provide all the stuff that they need, you answer the questions. They're going to probably make you answer something that's similar to a risk tolerance question to see what type of account you should have. And then they're going to ask you to scan and send your passport or a list of one or two things. A list of things that you can choose, 2 things to identify yourself. And you wire money from your US bank account here, or whatever US account that you have, you wire money to your brokerage account, and then you have money in your account, and you can invest on your phone or your laptop from anywhere. So that's how you would do that. But the US situation now, however US becomes available for you, once it's not illegal, you should go for it as well. If you can't get US dollars, invest your TT dollars on the local stock market. Invest your TT dollars. Money that is to invest in the stock market or mutual funds or set aside for saving, you set it aside.
All right, and last question for me. I think in speaking about building generational wealth, you identified 3 things, very specific. 1 was start a business. 2 was invest.
Real estate.
What? All right, well, real estate, and then the 3rd one then was
Stocks.
invest in stocks and bonds. One of the greatest investors, Warren Buffett, I think his philosophy is, well, value-based investing, but he always says he invests only in businesses he comprehends. For retail investors like this, could you explain how important it is to understand where we put our money? And if we don't understand it, would you still advise us to put money into those businesses?
Yeah. So, no, don't. If you don't understand, you never invest in anything you don't understand. And if you don't understand, that's all right. You need to be confident that the person that you're relying on or the institution that you're relying on is competent. And there's a way to do that. So people have to, people who work in the financial sector have to present their degrees, their papers, whether it's an undergrad or a master's. They have to be registered with the Securities Exchange Commission, who are the regulators to protect investors. So you have to do your homework and make sure that this individual checks out, that they are fit and they are proper. So you could take you can take their advice. So never invest in anything because unless your family member or friend is an investment professional, then yes, but nothing that you just read in a magazine here that, this thing doubling and tripling. They have a lot of schemes out there too. And people are very excited about putting money to put in 100 and get 10,000 and however these things go. That's very dangerous. So do not invest in anything that you don't know. The best way to start investing is thinking about products that you know and you experience. So like if, let's say you are on the international market, if you're into sports, you might be looking at a Nike sports apparel or the Nike brand because you a sneakerhead, right? I'm just using an example. Yeah. And you know the user experience with that. Like you have Nike sneakers or you have a Nike ball or you had Nike paraphernalia. And that's a great way to get interested in a company. If you're a female and you're into makeup or luxury, there are different companies out there that you would be familiar with. That's a great way because you're interested in the company. It's exciting because you're getting behind this company, you're learning certain things along the way while you're investing. So it's great to start with a company or an investment that you have a user experience with. So you know the company. So, okay, if you were to invest in, you all should have the best user experience, but nobody needs to comment with Massy. If you want to invest in Massy stock on the local stock market, for example, you have an idea, you know what management plans are, you know what the financials are saying, you would know that, last time I checked, Massy profit has grown since 2019 to the last 12 months, probably roughly 30%. So the company is generating profits consistently. You would know what the liquidity situation is. It's like is cash available. You know what the debt profile is. And the same way you assess a company is the same way you assess your personal balance sheet. If you go to the bank and you have too much debt, they're not giving any loan. If a company is not managing their debt profile and their capital structure is off, investors should not invest, right? So those are the things that you look for. Is it fairly priced? But you would know that, this company is growing. And again, let me stick up in here. This is not investment advice to invest in Massy stock. I'm giving you an example as to what you think about when you're making an investment. So find someone who can talk you through what is a good investment, find information and material that could guide you along the way to know if an investment is good or bad. And it's on that basis, and only that basis, that you can feel confident that, okay, I am confident in the stuff that I have learned. I am confident in my ability to assess an investment. Or I am confident and I trust this individual or this institution to give me the correct advice to invest in these stocks or bonds. And that's the only time that you should invest.
All right, perfect. So if no more questions, folks, that's the show for today. So thanks so much for Phil for making it.
All right,
I appreciate that.
All right. Very nice. Yeah, man, bro. Thanks so much. Yeah. It's a good time. Did you all enjoy the session? Yes. All right.